Welcome to the Deep Dive. Today we're unpacking the second quarter 2025 earnings call for Axcelis Technologies. That's ticker ACLS. We've got the details here, and it looks like a really interesting story, a company doing surprisingly well despite industry headwinds.
That's right. Axcelis put up numbers that definitely got the market's attention. Shares popped higher, and it signals some really strong execution, especially when you consider the wider semiconductor industry is in what they're calling a cyclical digestion period.
Right, that digestion period. Basically, the industry taking a bit of a breather, working through inventory, right? Slowing down after maybe growing too fast.
Exactly. Demand catches up, new investments pause. So Axcelis shining through that is notable. We're going to dig into what exactly drove that positive market reaction, and importantly, what you should probably keep an eye on going forward.
Okay, let's start with that results snapshot then, because they really did deliver. A significant beat against expectations. Non-GAAP EPS, for instance, came in at $1.13. That was way above what the street was looking for.
And revenue, too. $194.5 million. Also comfortably beat projections. But here's what's maybe even more compelling. The profitability. Non-GAAP gross margin was 45.2%, and the operating margin, non-GAAP again, 17.7%.
Wow, okay, so strong margins even with the beat. That suggests good cost control, favorable mix.
Both, yeah. Disciplined costs, selling the right stuff. For a company navigating that digestion, those margins really tell a story about how they're managing things.
They're absolutely solid margins, but there's always a but, isn't there? The nuance here seems to be the bookings. Bookings for the quarter were $96 million. That's actually down slightly from the previous quarter.
Right, and that leads to a book-to-bill ratio of 0.8x.
Okay, so for anyone maybe newer to this, book-to-bill compares new orders, the bookings, to what they actually shipped and billed. Under 1.0 means, well, they shipped more than they booked in new deals.
Precisely. So while Q2 performance was strong, that 0.8x figure in the backlog sitting at $582 million, it suggests a more cautious view on near-term new orders.
It's that divergence analyst flag, right? Great results now, but a question mark over the immediate pipeline.
Exactly. It's a key tension. But let's dive deeper into the financials first. So that $194.5 million revenue, systems revenue was $134 million of that. And the rest, $61 million, came from customer solutions and innovations, or CS&I.
CS&I, that's basically their aftermarket business, right? Spares, service, upgrades, maybe used tools.
You got it. It's a really critical part of their model, that CS&I piece.
And looking at their balance sheet, it seems incredibly strong. About $581 million in cash equivalents and marketable securities. That's quite a war chest. What does that kind of cash let them do, especially when the market's maybe a bit slower?
Oh, it's a huge advantage in a period like this. It means they can keep investing in R&D without taking on debt. They can pursue strategic things and, importantly, return cash to shareholders.
Like the buybacks.
Exactly. They repurchased $45 million in shares just in Q2. They have that expanded $215 million authorization from March. It signals management's confidence in the long-term value, even if near-term orders are a bit soft.
Makes sense. Connects to the bigger picture. And geographically, wow, China was huge for them in Q2. 65% of shipped system sales, that's a massive jump from 37% in Q1.
It really is. And for total revenue, China was 55%, the US 18%, Korea 13%. That heavy concentration in China, it's definitely a key factor. Huge growth driver, obviously, but also a concentration risk point.
Especially with what management called that fluid tariff environment, it feels like a bit of a double-edged sword, doesn't it?
Absolutely. It magnifies the upside and the potential geopolitical bumps. Now let's talk about what management actually said. Their perspective is crucial here. The CEO highlighted strong results despite the cyclical digestion period. They pointed to momentum in CS&I and focus on high-value applications.
And they mentioned something about engaging more with customers during these quieter times, because customers ramp up R&D.
Yeah, that's a really insightful point. When capital spending slows, customers often look at optimizing existing processes or planning the next tech node. So Axcelis wants to be deeply involved in those R&D conversations, positioning for the next cycle.
Which brings us back to that CS&I segment. You said it was critical. Can you elaborate on why it's so resilient for them?
Sure. So CS&I was about 30% of their revenue in the first half of 2025. The key thing is stability and margins. It has materially higher gross margins than the overall corporate average.
Ah, okay. So it's a steady, profitable stream.
Exactly. Think about running a fab. New tool orders are cyclical, they go up and down. But the need for spares, service consumables, upgrades for the tools you already have, that's much more consistent.
Right, it's less discretionary.
Precisely. It's driven by tool utilization, customers wanting to get more out of existing assets. It smooths out the bumps inherent in the equipment cycle.
Got it. And a huge driver for them currently seems to be silicon carbide, SiC. We hear that term a lot. Why is SiC so important for Axcelis specifically? And what's behind this demand surge?
Okay, yes, SiC is essential to their story right now. Silicon carbide is a compound semiconductor material, really good for power electronics. Think electric vehicle power inverters, EV charging stations, industrial power, renewables.
High power, high efficiency applications.
Exactly. And demand for SiC devices is, as they say, firm, especially in China, where there's huge investment going into supporting the EV industry. They're building out capacity for both 150 millimeter and 200 millimeter wafer applications.
150 and 200 millimeter, those are the wafer sizes, right?
Okay.
Bigger means more chips, generally more advanced.
Correct. And outside China, the R&D focus is also intense. Customers are working on technology transitions, like moving to 200 millimeter superjunction designs.
Okay, superjunction. What does that mean in simple terms?
Think of it as a really advanced way to build the power transistor, allowing it to handle much higher voltages and switch faster, more efficiently. And making these complex structures, especially on larger 200 millimeter wafers, heavily relies on high-energy ion implantation.
Which is Axcelis' core strength.
Exactly. Ion implantation is critical for creating these SiC device structures, so Axcelis is right in the sweet spot.
And the long-term drivers for sinking SiC seem solid too. EVs, renewables.
Absolutely. Growing EV adoption means more SiC content per car. Higher voltage applications are demanding it. And as device prices come down, it opens up even more markets, like data center power supplies. It's a powerful, long-lasting trend.
Okay, makes sense why SiC is such a focus. But what about the other parts of the semiconductor market for them, like memory or advanced logic? Any green shoots there?
Memory, unfortunately, is still pretty muted. NAND and DRAM spending is expected to stay soft for the rest of the year. Customers are focused more on, say, stacking more layers in NAND, which uses deposition and etch tools, rather than buying new implanters right now.
So different tools needed for that phase.
Right. There were some small opportunistic buys for DRAM, but nothing major for memory. And for general mature nodes, the older chip technologies, it's still that digestion period. Revenue declined slightly sequentially.
But you mentioned some encouraging signs.
Yeah, they noted pockets of improved tool utilization. So customers are using the equipment they have more, which is often a precursor to needing more capacity eventually. It's a small positive sign.
Okay. And advanced logic, the really cutting-edge stuff.
That remains an area where Axcelis is frankly underpenetrated. They don't have a huge market share there yet, but they are actively working on it, engaging with customers, getting evaluation tools out for next-gen applications. We're talking M+1, M+2, M+3 nodes, basically the next few generations of chip technology.
And things like backside power delivery? That sounds complex.
It is. It's about new ways to get power to the transistors more efficiently on these incredibly dense chips. So Axcelis is playing the long game in advanced logic, investing in R&D, trying to win those future sockets.
Okay, that covers the current state and the tech drivers. Let's pivot to the outlook. What guidance did they give for Q3?
For Q3 2025, they're guiding revenue around $200 million, non-GAAP EPS about $1, and non-GAAP gross margin around 43%.
43% gross margin. That's a step down from the 45.2% they just posted in Q2. Why the dip?
Good catch. They attributed that sequential decline to mix shift, specifically a higher proportion of systems revenue compared to that high-margin CS&I revenue.
Ah, right. More lower margin new tool sales relative to the higher margin aftermarket stuff pulls the average down.
Exactly. It's about the blend of revenue. Not necessarily a negative signal on its own, just how the math works out based on what they expect to ship. Looking even further, the initial view for Q4 is for revenue and gross margins to be pretty similar to Q3 levels. Operating expenses might tick up slightly.
And any macro commentary? Tariffs. Geographic reporting changes.
Yeah, they mentioned monitoring the fluid tariff environment, and the Q3 guide includes a modest estimated impact from that. They're also changing how they report geographic revenue, moving to total revenue only, which they say aligns with peers.
Okay. And any specific comment on China for the second half, given its huge contribution in Q2?
They expect China revenue in the second half to be similar to the first half. Suggests customers there might be digesting some of the big investments they made earlier. So still strong, but maybe leveling off sequentially.
Right. And what about competition? Particularly in China, are new players emerging?
They acknowledge two Chinese competitors, but describe them as immature. Apparently, these competitors aren't really seen outside of China yet and are still early in their tech development.
So Axcelis isn't sounding overly worried near term.
Doesn't seem like it. They seem confident that their leadership in high-energy implant, especially for the advanced SiC stuff, is a strong differentiator that's hard to replicate quickly.
Okay, so bringing this all together for someone tracking Axcelis or the semi space, that positive market reaction to the earnings makes sense, right? Big beat on top and bottom line, strong margins despite the industry slowdown. Investors reward that kind of execution.
Absolutely. Outperforming when things are tough is always well received. But looking ahead, there are specific catalysts you really need to watch. First, track that Q3 gross margin. Does it come in at the guided 43%, or can they beat it? That tells you about mix and execution. Second, any news on incremental Sakai orders? Visibility into the China power device market is also key, given how important that region is right now.
Yeah, and for me, I'd be watching for a turnaround in the order book, a significant jump in new orders, rebuilding that backlog. Getting that book-to-bill ratio back above 1.0x would be a really strong signal that the digestion is easing for them specifically.
Definitely. Also, keep an eye on the pace of share buybacks. Are they continuing to actively use that authorization?
Yeah.
And of course, any broader signs of life returning to the memory market, even if it's not their main driver right now, it impacts overall industry sentiment.
Which brings us back to that divergence point you mentioned earlier.
Right. Strong Q2 results, management sounding firm on SiC demand, but then you have the sub 1.0 book-to-bill and the declining backlog. That's the tension. Will future orders catch up and validate the optimism, or will this gap persist for a while? That's the core question for investors now.
And their competitive edge really matters here. That leadership in high-energy implant for SiC, those super junction devices.
And the CS&I business, yeah. That stable, high-margin, recurring revenue stream. Those are the things that give them resilience when the broader market is choppy. They aren't just another equipment supplier.
Okay, time for our This Is Not Financial Advice segment. Just throwing out an idea, a thought experiment for, let's say, a sophisticated investor. Given the Q2 beat, their solid position in CS, that big cash pile for buybacks, here's a potential play. Go along Axcelis ACLS. Maybe target, say, a 2.0x sales multiple based on 2026 estimates. But, and here's the kicker, make it contingent on them landing a major design win in advanced logic within the next maybe 18 months.
Oh, okay. So betting on them breaking into that underpenetrated market. And how would you structure that to manage cost?
Well, to potentially reduce the upfront costs, you could consider selling some out-of-the-money call options against the long position.
So using the current market focus on CD to generate some premium, capping some of the near-term CEO-driven upside, while positioning for a potential re-rating if they nail that advanced logic win.
Exactly. It's definitely speculative. It's a bet on their R&D paying off in a whole new area beyond the SiC story everyone knows, a different growth vector entirely.
Interesting. It's definitely thinking beyond the current cycle.
Okay, so let's recap our deep dive then. Axcelis put up a strong Q2, beating expectations pretty handily. Robust margins, healthy cash balance, really powered by that leadership in SiC and the steady CS&I business.
Yeah, and while the broader industry is still in that digestion period, their execution looks solid. Management seems disciplined, making strategic investments. They look positioned to navigate the headwinds.
So the final provocative thought for you, our listener, to maybe chew on. As you look at the semiconductor landscape, is the market fully appreciating Axcelis' long-term potential in SiC? That runway seems pretty strong.
Or will the ongoing softness in memory and that near-term dip in the book-to-bill ratio continue to hold the stock back, overshadowing its strengths until we see a clearer, broader industry recovery?
Something to think about. We definitely encourage you to dig into these numbers yourself, see how they fit your own view. We always value your insights. Let us know what stood out to you from this Axcelis earnings deep dive.